Millions of dollars are left unclaimed by crypto investors every single year. This secret crypto tax loophole is real. Most people do not know about it. It can save a typical investor $3,000 or more right now. Tax laws around cryptocurrency are confusing for everyone. Many believe they cannot sell crypto at a loss, then buy it back quickly. They think a wash sale rule applies. That rule is for stocks and bonds only. It prevents claiming a tax loss if you repurchase the same security within 30 days. But here is the critical part. Crypto assets are not currently considered securities by the Internal Revenue Service for this specific rule. This means you can sell your Bitcoin at a loss, then immediately buy more Bitcoin back. You can do this with Ethereum too. And any altcoin you own, this simple move allows you to claim a capital loss on your taxes. The loss offsets your capital gains. It can even offset up to $3,000 of ordinary income each year. This one difference is a massive advantage for crypto holders. It is a powerful tax strategy. Imagine selling one Bitcoin for $20,000 that you bought for $25,000. That is a $5,000 loss. You instantly buy back one Bitcoin for $20,000. You still hold the same amount of Bitcoin, but now you have a $5,000 tax loss to use. This loss can wipe out other crypto gains you might have made earlier in the year. It can also reduce your regular income. Many crypto investors are not aware of this specific distinction. They just let potential savings disappear. Data shows the average crypto investor has seen price volatility of 50% or more in the last 12 months. This volatility creates opportunities for tax loss harvesting. Think about those smaller altcoins too. Perhaps you bought an altcoin for $100. Now it is only worth $10. You can sell it and buy it back. You just generated $90 of tax loss. Repeat this process across your portfolio. The savings add up fast. Crypto market capitalization hit its peak in 2021, reaching nearly $3 trillion. Even with recent downturns, it remains a multi-trillion-dollar market. Millions of individual investors hold crypto assets. Estimates suggest over 50 million people in the United States alone own cryptocurrency. Many of these individuals have unrealized losses from bear market cycles. This loophole is especially useful for them. You might have bought Ethereum for $4,000. Now it is $2,500. That is a loss of $1,500 per coin. You could sell it and instantly repurchase it. You keep your position, but create a tax advantage. This action is perfectly legal under current IRS guidance. There are no direct prohibitions for crypto wash sales. This contrasts sharply with traditional investments. A typical stock investor cannot do this. Their loss would be disallowed. Crypto investors have a unique window. This window might not last forever. Regulators are always reviewing digital asset rules, so acting now is important. One major exchange processed over $500 billion in crypto trades last year. This volume means many opportunities for tax events. The average portfolio size for crypto investors ranges from $1,000 to often more than $25,000. Even smaller portfolios benefit greatly. If you have only a $500 loss, you can still claim it. It contributes to your total loss pool. The $3,000 maximum for offsetting ordinary income is a yearly limit. Any losses beyond that can be carried forward to future tax years. This carry forward feature makes the strategy even more valuable long-term. Imagine carrying $5,000 in losses to next year. That is powerful. Many investors might hold multiple different cryptocurrencies. They could have Bitcoin, Ethereum, Solana, Cardano, and Dogecoin. Each of these can be treated separately for tax loss harvesting. You could have a gain on Solana, but a loss on Cardano. You sell Cardano and buy it back. That loss reduces your overall tax burden. This is not about avoiding taxes entirely. It is about legally reducing your tax liability. The average tax rate for capital gains can be high, up to 20%. Saving $3,000 means you avoid paying $600 in taxes if your rate is 20%. That is real money staying in your pocket. One survey found 40% of crypto investors were unaware of basic crypto tax rules. This lack of knowledge costs them money. Another study indicated only 10% of crypto investors actively engage in tax loss harvesting. That is a huge missed opportunity. For 90% of them, this loophole is not hidden. It is a direct consequence of how the IRS classifies digital assets versus securities. It is a clear distinction. Anyone with crypto losses can potentially use it. You just need to document transactions correctly, keep good records of your sell and buy orders, note the dates, prices, and quantities. This is crucial for tax reporting. Many specialized crypto tax software tools can help. They integrate with exchanges, they track trades, they generate reports. Some of these services cost less than $100 per year. That is a small price for potentially saving thousands. Consider a scenario where you made a $5,000 profit from NFTs earlier in the year. Then you had a $9,000 loss on your altcoins. You can sell those altcoins, buy them back immediately. Now you have a $9,000 loss to offset your $5,000 NFT gain. You also have $4,000 remaining. This $4,000 can offset $3,000 of your ordinary income. The final $1,000 carries forward to next year. This is a very efficient way to manage your crypto portfolio. It is not just for huge whales. Everyday investors can use this too, even if your initial investment was just $1,000. If it dropped to $500, you can still harvest that $500 loss. It all adds up. The crypto market is still young compared to traditional finance. Its regulatory landscape is still evolving. This loophole is a direct result of that evolution. It is a temporary advantage. There is no guarantee it will always be there. Legislators could change the rules at any time. The proposed Responsible Financial Innovation Act mentions potential changes. It could classify digital assets differently. This could lead to wash sale rules for crypto. So the window to use this strategy might close. Experts advise using it before year end. Many financial advisors are now recommending this to their crypto-savvy clients. It is a legitimate way to reduce taxable income. Do not confuse this with tax evasion. This is completely different. This is tax minimization. It is allowed by current law. The average crypto trade volume is hundreds of billions of dollars daily. There are so many opportunities for these tax events. Every investor should look into their own portfolio, check for any unrealized losses. Even small ones are worth considering. This could mean a few $100s or thousands. The impact on your overall financial health is significant. Think about the costs of living. $3,000 is a lot of money. It could cover a month's rent. It could pay for groceries for several months. It could pay off credit card debt. It could boost your savings account. This is not just theoretical savings. It is actual money that you keep. So many people just file their crypto taxes without exploring these options. They just accept their fate. But there is a better way. This one simple step can change their tax outcome drastically. It needs to be understood. It needs to be acted upon. Do not let $3,000 just slip away. This is not a complex strategy. It is quite straightforward. Sell low, buy back low, report the loss. That is the essence of it. For many investors, this is a huge game changer. It is the kind of insight that separates savvy investors from average ones. It is about understanding the rules of the game and playing it smartly. This is not a trick. It is a feature of the current tax system. It exists now. It can benefit many, many people. So check your crypto portfolio today, look for those losses, make them work for you. Do not let the tax man take more than he is legally due. The strategy applies to assets held for both short-term and long-term periods. The type of gain or loss will dictate how it offsets other gains or income. Short-term losses offset short-term gains first, then long-term gains. Then ordinary income up to $3,000. Long-term losses have a similar but distinct order. Understanding these classifications is important, but the core principle of harvesting losses remains the same. You are turning paper losses into realized tax benefits. This requires a little bit of active management, but the payout is significant. It is truly a secret for many, but it does not have to be for you.